Hello, my trading friends, and welcome back to Forex Focus, brought to you by IG. Taking a look at the hot job data that just came out here in early June for May. Non-farm payrolls way higher than expected, reversing a ton of recent trends that we saw throughout April and May, and causing huge reversals in gold, US dollar, interest rates. Stocks pretty mixed, trading both sides after this non-farm number did come out, but we're going to cover all of those stories. Let's start with the jobs report itself. Now, keep in mind that the non-farm payrolls number is essentially monitoring the employment change for better or worse. And, economic downturns, this number can be negative. As you can see here, it's been positive to the tune of 150 to 300,000 jobs throughout the last several months. This month, the expectation was around 185,000, still a solid number, but not nearly as solid as we saw in December, January, February, and March. In April, that was the first number that really started to slip here in the U.S. and sent a whole bunch of alarms across a bunch of different asset classes, with that number in April coming in lower, under 200,000 for the first time this year. You saw interest rates move lower. You saw US dollar move lower. You saw gold and equities move higher on the idea of interest rate cuts coming from the Fed sooner than anticipated, with the idea being that, man, if this job market is going to fall, then the Fed needs to cut rates to pick the economy back up. Inflation's already in the 2 to 3% range, so we'll just call it 2% and move on. Not so fast, because now the employment data has come out super hot here for May. Like I say, way higher than the bank analyst estimate at 185, all the way up at 272, and looking a lot like those numbers we saw in December, January, February, March, when what was happening? Interest rates were on a run up, and they were pricing out those Fed rate cuts. Let's take a look at the damage done across the different asset classes. Gold falls more than $50, and it was a pretty precipitous fall. Anybody who's used to trading the gold market knows that, a $15, $20, $25 day, that's a pretty big day. Falling more than $50 on the same day as this non-farm report comes out, with the idea being that the non-interest bearing gold asset is maybe less attractive if interest rates from the US Treasury are going to stay higher. Now, of course, in the grand scheme of things, this is an expensive gold market, up above 2,300 as it's been for the last couple of months. But we'll see if this data, as well as the coming inflation data and the Fed meeting that's due here in June in just a handful of days, if they do combine to move this gold market continuation lower, closer to 2,300, or if it continues to be comfortable here in the 2,350 to 2,400 region. But yeah, $50 fall back below 2,350. We'll see where gold futures trade in the near future here. Let's get on to yields, though, because this is really the driver of the gold market and the US dollar market in a lot of ways. And you can see here a big bounce back in the 10-year yield, as it had fallen from above 4.6% about a week ago to close to 4.2%. I mean, a 40 basis point fall in a matter of a week is a huge, huge drop in Treasury yields, now bouncing back to more or less split the difference around 4.4%. And across the curve, we saw pretty much 10 basis point rise for the 2-year, the 10-year, and the 30-year. Again, the idea being, if jobs are still so strong here in the U.S., then if the central bank is monitoring jobs data, the unemployment rate, and inflation data, the inflation rate, those are the two main data points that the central bankers look at. Well, if inflation is still relatively high, calling for continued high interest rates, and employment data is still relatively strong, then they can keep those interest rates higher for longer, and thus you have the run-up here in Treasury yields when it looked like they were just going to start to collapse here in the last handful of days, because the Fed feels like they can maybe lean up against a strong U.S. economy and keep these interest rates higher. Now, if this job data came in weaker than expected, then maybe with those two data points in mind, and this one now being lower than expected, they might have to drop interest rates lower to pick up that worsening job market. But given the most recent data, doesn't look like it's necessarily worsening by adding almost 300,000 jobs a month. Let's move on to the U.S. dollar market, because what you tend to see in times like this is U.S. interest rates strong, U.S. dollar strong, and this U.S. dollar was strong coming out of this number, appreciated by more than 50 pips against a handful of foreign currencies, including the big names, euro, yen, Australian dollar, and a multitude of others. And this might look like a little blip here looking at that euro dollar chart, but that's a big red bar in a market that was hovering right around 109 for a handful of days. And maybe people thinking that this non-farm number, if it comes in weaker and then the Fed comes out next week and says, hey, we're worried about employment, maybe we will cut rates 2 or 3 times here in 2024, that euro could have gotten back up to 110 and above. Not so fast. U.S. dollar appreciating here again, reversing this recent trend and some huge moves across the board, especially if you're looking at that Aussie, but also take a look at that Mexican peso has obviously been weak for its own reasons, but man, some of these currencies getting slammed on this U.S. dollar strength that we're seeing come out of this hot jobs number. Let's wrap it up with a little bit of forecasting from the futures market on where the Fed might land interest rates in the near future. Everybody's been looking at September now for the first rate cut from the U.S. central bankers. We had the Euro area central bankers cut interest rates recently. Canada cutting interest rates. The trend seems to be cutting, right? But when will it happen? It was June for those major central banks abroad. In the U.S., we thought it was going to be March, and then we thought it was going to be June. The odds for a cut this month, very, very low. And now we've been thinking it's going to be September, and still may be, but these odds have gone from 68% yesterday to now close to 50-50. Huge, huge swing in interest rate markets like we just saw, right? It's synergetic. You see 10 basis point rise across the yield curve. You might think that the odds of an interest rate cut to the overnight rate from the Fed are probably going to get less likely. So now a 50-50 shot here. Futures traders are thinking for that September rate cut. And if they don't cut in September, only a couple meetings left. Now, of course, we can't get ahead of ourselves. This is just midway through the year data. But right now, trends pointing to a stronger U.S. interest rate market, stronger dollar, and some weaker assets like gold coming off of this hot non-farm.